Recapitalization is simply increasing the capital base of banks. In 2004, the capital base of banks used to be 2 billion naira, but it was increased to 25 billion naira. Since then, there hasn't been any regulatory induced increase in the capital base of banks. So now what the central bank is saying is that banks should shore up their capital base. Okay? Capital is the money that belongs to the owners of the business. So when we say capital base of banks, it means the owners of the bank should increase their share in the business.
Their investment
in the business, what they are using to run their business, increase your share. Okay, so that's what recapitalization is saying. So this time the central bank says that there is need to recapitalize because since 2005 a lot has happened. Inflation rate has been on the high side. The naira has lost a lot of value. In 2005 the exchange rate was around 130 naira to the dollar. Today it is 1,300 naira to the dollar. So you can see the level of depreciation that has happened over time. Okay, so the capital that banks are using to do business is no more as strong as it used to be. And some of these banks, especially those of them that have international license, or what central bank calls international authorization, they play abroad. They also need to be strong to be able to compete, okay, abroad and do business abroad. So that's why the central bank is saying that the need has come now for you to recapitalize, to shore up your capital base. So of course, we have commercial banks, we have merchant banks, and we have non-interest banks. These are the three major categories. Now, for commercial banks, some of them have international license. Central bank says you need to take it up to 500 billion naira. Some of them are holding national license. The international bank, the banks with international license include the likes of Access, Zenith, GT, UBA. Okay, so they are expected to move up to 500 billion. Now, there are also those with national license. These ones are expected to do up to 200 billion. Okay, the likes of Wema Bank, the likes of Sterling Bank, okay, they are holding national license. Union Bank, okay, national license. And then you also have the ones that are holding regional license. Providus Bank, for example, Globus Bank, they are expected to do 50 billion naira. And then of course we have the merchant banks. Merchant banks, Coronation, Merchant Bank, Rand Merchant Bank, Nova Merchant Bank, they are expected to do 50 billion naira for merchant banks. Now you have non-interest banks. Okay, non-interest banks are, if they operate nationally, they are expected to have their share capital up to 20 billion. And for regional, 10 billion. Non-interest banks include Jais Bank, Taj Bank, Lotus. Okay, so overall, all of them will be required to recapitalize. But as I said earlier on, capital is what belongs to the owners, what the owners have in the business. So the central bank says, for the purpose of this recapitalization, okay, we want you to bring fresh capital. And okay, so it is about share capital plus your share premium. Don't go and say you have been saving, or you have something in your reserves and you bring it and say you want it's part of your capital base. Central bank says no, they won't allow you to use your retained earnings. Central bank also says central bank has given three options. Okay, one is that you can go to the stock market and issue shares to be able to raise your share capital with what we call offer for subscription. You can also go to do rights issue. Rights issue is when you decide to issue the shares to your existing shareholders, the owners. Okay, you ask them to bring more money. You are not going outside. That's rights issue. Then you can also do private placement. You identify people that you think that have the money, high net worth individuals, and you raise the money from them. So that is one line, one option. The other option is that if you can't do this, You can also choose to merge. Mergers and acquisition is another line. The third option, of course, is for those that would be unable to meet up, or those that are also able to meet up, but exceed a particular threshold. So there's a provision for downgrade. You can't meet up. You're having a national license. You can't meet up. You can come down to regional. Okay. You can also be upgraded. So these are the three options. And for the purpose of recapitalization, as I said earlier on, the central bank has said it's only the share capital that we are concerned with. Okay, because that is what is permanent, and not your revenue reserves, and not your total shareholders fund. Maybe I should also explain. When we say shareholders fund, comprises the share capital of the bank, the retained earnings, which is revenue reserves, okay, sometimes, of course, the capital reserves, if available. If a bank has revalued assets, okay, your assets used to be maybe in the books, you're carrying them at maybe 1 million naira, and suddenly you now say it is 2 million. So the central bank says we don't want that kind of revaluation. Okay, and there's also the issue of this exchange gains. You are holding dollar assets, and because exchange rate has gone up, you now come and say the value of that has now gone up, so your capital has increased. Because these things are unrealized, they don't translate to cash. Central banks excludes them. That's why it's the contentious aspect. Maybe we'll discuss it further later. Okay, the central bank says what they want is fresh capital. Okay, and
that's the injection of money into the system.
Yes, and they've also said that they wouldn't want you to go and say you are issuing bonus. You look at your reserves, you capitalize, use your reserves and capitalize them, convert them into fully paid shares, and say you're issuing shares to capitalize. Again, there's no cash coming in. In a bonus issue, no cash is coming in. Central bank also says they're not going to allow what they call additional tier 1 capital. Additional tier 1 capital is made up of hybrid securities. Okay, when we say hybrid securities, we are referring to things like preference shares. Okay, preference shares are not the same as common shares or equity. So central bank says they're excluding preference shares, they're excluding also certain categories of convertible securities and bonus issues. So it's only share capital and share premium that they want to allow. Now, what is share premium? Share premium is when you issue shares above the par value of your share. If the par value of your share is 1 naira and you issue it at 1 naira 50 kobo, 50 kobo is the premium. So central bank allows that, okay, because cash has also come in. So ultimately what the central bank is saying, we need you to move from point A to point B, bringing in fresh cash, fresh capital. And if you look at what central bank has also done, central bank has adopted a risk-based approach. The international banks, this is what you need to do. And for those with international license, a good number of them, if the central bank were to allow retained earnings or revenue reserves, okay, ordinarily they would be meeting the 500 billion. Okay, because some of them, like Access Bank, for example, Access Bank has share capital about 248 billion. Okay, Zenith has about 270 billion. So what they need to make up, in the case of Access Bank, for example, it's about 250 something. It's about 240 something billion. That's what they need to make up the 500 billion.
That is not required.
Yes, that is not required. So from the look of things, 2 years is sufficient time for these banks, to be able to do that. So I think, in my view, the 2 years time period, is adequate.
Sufficient.
Yes, sufficient. And what is the whole essence? You ask the question. It is to make our banks stronger. It is to make the banks also safe, sound, and more resilient. Okay, depositors can also go to bed and sleep with 2 eyes closed because their deposits are
safe.
Are safe and secure. So I think when you look at it, maybe much later I'll talk about the concerns, but when you look at it, the positives outweigh the negatives. Yes.